Banking has been around for centuries, helping people store money, process payments, and take out loans. But today, a new contender has emerged: blockchain. Is this technology set to disrupt traditional banking, or can they coexist? Let's explore the key differences between blockchain and traditional banking. Traditional banking is built on centralized structures. Banks hold your deposits, process transactions, and provide services like loans and savings accounts. They're regulated by governments and follow stringent rules to ensure consumer protection. However, this centralization also means banks have the power to freeze accounts, set interest rates, and control access to funds. Central authority. Banks act as the gatekeepers, managing and verifying transactions. Regulations and compliance. Governments enforce laws to maintain trust and stability in the financial system. Fees and delays. Transactions, especially international ones, can be slow and expensive due to multiple intermediaries. Blockchain, on the other hand, is a decentralized, digital ledger. Instead of relying on a single institution, transactions are validated by a network of computers around the world. Each block of data is linked to the previous one, creating a chain that's nearly impossible to alter without consensus. Decentralization. No central authority. The network itself confirms transactions. Transparency. Anyone can view the ledger, making fraud or manipulation significantly harder. Security. Transactions are secured via cryptography and consensus mechanisms like proof of work or proof of stake. Key differences: 60 to 90 seconds. Control and ownership banking. The bank holds and manages your funds. You need permission to move large amounts or make certain types of transactions. Blockchain. Users hold their own private keys, giving them full control. There's no centralized body to approve or deny transactions. Transaction speed and cost banking. International transfers can take days and incur significant fees due to multiple intermediaries. Blockchain. Transactions can be faster, though speeds vary by network, and fees often go directly to the miners or validators, potentially lowering costs. Transparency versus privacy banking. Your transaction history is private, accessible by you, the bank, and sometimes regulatory bodies. Blockchain. Transaction data is public on the ledger, but individuals can maintain anonymity through wallet addresses. Security and risk banking. Banks often offer insurance like FDIC or government guarantees, protecting deposits up to certain limits. However, if the bank system fails, your access to funds can be restricted. Blockchain. Security is maintained through cryptography. However, if you lose your private keys or fall victim to a scam, there's no central entity to recover your funds. Each system has advantages and drawbacks. Traditional banking pros: stability, consumer protections, and government backing. Traditional banking cons: centralized control, potentially high fees, slower international transactions. Blockchain pros: decentralized control, reduced middleman fees, faster cross-border payments, and heightened transparency. Blockchain cons: steeper learning curve, no safety net for lost private keys, and regulatory uncertainty in many regions. While traditional banking has reliability and regulatory frameworks on its side, blockchain offers innovation, transparency, and greater individual control. It's not necessarily a question of which system will win, but rather how both can evolve and potentially coexist in a future where technology continues to reshape our financial world. Interested in more insights on blockchain, banking, and the future of finance? Subscribe and keep exploring with us.